How many years do you need to become a billionaire? Some people did it in 10 years, while others in the 50. It highly depends on the person and the circumstances, but the person outperformed everyone else. When Facebook was still an idea, Eduardo Severin decided to invest in the $50,000. He stayed in the Facebook for at least then a year since he had a terrible relationship with Mark Zuckerberg. But what little investments and a year in the Facebook turned him into the billionaire. His net worth today is over $11.3 billion, but not everyone gets such an opportunity. Quite often, people have to build their wealth from the scratch, step by step. However, one of the ways you can reach your financial goals faster is by investing, but the problem is that investing isn't easy. It's complicated, competitive, and cruel, and if you don't know the rules, you'll probably just lose your money that you work so hard to earn. So, if you want to be one of the few who actually make money by the investments, master the rules first. Number one, hope is not strategy. There are three types of the companies you should invest in. One, it's the stable company. It has the great product, excellent leaderships, and good financial statements. So the company would probably keep growing, and your investments, if you decided to invest in this company. Secondly, it's the great company, but the stock's price is undervalued regardless of the reasons. Maybe it's received some negative press recently due to some minor issues, but the stocks will definitely rise back to its true value. Thirdly, the company it's making money now, let's say it's the startup, but it has the general potential. It might be the brand new industry, or they are developing breaking through technology, and in the long run they could be making the huge profits. But to invest in such companies, you need to have the deep understanding of that industry and the business overall. You can't simply choose the company based on how cool its name sounds and hope that it will grow. Can you get lucky? Maybe, but the hope is not a strategy. So invest only in the companies you understand. Secondly, time is more valuable than money. The problem with the investing is that if you want to earn a reasonable amount, you have to invest quite a sum of the money. Your $1,000 will earn you 80 bucks at the best anyway, assuming 8% rate of the return. But if you invest $1 million with the same rate of the return, you will be making $80,000, which can provide you with the good quality of living. But earning that $1 million is the problematic part. You can't save all of your paychecks. You have to put food on the table and keep the roof over your head, and that's where the magic common interests comes into the picture. Even with the little as a few $1,000s, you can reach to the millions if you take advantage out of the time. Let's say you just graduated from the high school and you have saved $2,000 from the pocket money you have been given in the last few years. That's a lot of the money, of course, but not that much. You decided to invest it into the enroll in college and get part-time job, but you decided to live frugally and invest another $200 every month by the saving up, a bit on unnecessary expenses such as the Starbucks coffee. At first glance, it seems like you can't save that much, and you are right. Even if you increase your savings with the rate of inflation 3%, you will save $182,000 over the course of 40 years. But because you have been investing in and reinvesting the interest and not merely saving it, it turns into $1.6 million. In fact, in the first 20 years, you won't cross 200K, but at the last 20 years, you will earn $1.4 million. Why? Because of time. Of course, no one wants to wait 40 years before they can turn millionaires, but the message is the earlier you start, the bigger the advantage you would have. Thirdly, buy when there's blood on the streets. Brandon Rothschild, in the 18th century British nobleman and member of the Rothschild banking family once said, "The time to buy is when there's blood on the streets." This rule does not apply to the stocks market, but to any kind of the investments, because humans are too emotional and are divided by their feelings. Instead of the making rational decisions that based on the data and the focus, most people would go with their guts. For instance, a bank would go bankrupt. All of the people who keep their savings in the bank would lose their savings. Other people would see that and would rush to their banks to withdraw all their savings, being afraid that their banks might go bankrupt as well. But because everyone has withdrawn their savings, the bank goes bankrupt, and that will push other people to do the same, slowly bankrupting every bank in the country and crashing the entire economy. The panic destroyed the entire economy, but that's just in theory. In practice, well-established companies or banks survived such panics, but lose a lot of their value. In times like ours, the certainly has created a panic in the market, which led us to the investors to sell their investments and scared of other investors from the buying, which results in the significant crash in the market. However, once the panic fades away, businesses will get back to normal, and all of these companies will gain back their value. That's why when there is a chaos or panic in the streets, that's the best time to invest, since a lot of the great companies would be undervalued. Next, don't let greed destroy you. In 2003, Warren Buffett invested $488 million in the PetroChina and around 37 billion valuations. At that time, it didn't seem to like the good investments. A couple of the years later, oil prices have soared, and China's economy was showing any sign of the slowing down. And with the series of the good to fundamental earnings reports, PetroChina stocks jumped significantly to the point where PetroChina crossed the $1 trillion valuations. Buffett could have made $13 billion out of this deal, but as the company reached valuations of around $300 billion, Buffett sold his entire stake and made only $3.5 billion. The lesson is, don't be too greedy, because your greed can end up losing your money. You more money than you could possibly earn. He could have waited longer, but how could he possibly know that it will crash? PetroChina is now trading at the $150 billion valuation. Number 5. Diversifications is nonsense. How many stocks do you own on average? What do you think? Some people say 10, others suggest 20 or 30 in order to diversify your portfolio enough. But there is the questions. Let's say you have the great company in front of you. It has the great products. It's financial statements are strong. The company has excellent management and leadership. The question is, why would you invest in any other company if you have the opportunity to invest in this company? And that's why diversification isn't really the great strategy. But you might say, aren't many such companies fair enough? You are right. That's why you should only invest in the few great companies. So how many stocks should you own? As fewer as possible. With each extra stocks you buy, you have to spend extra time to resource to follow, read its financial statements, and make the financial analysis. Of course, you should not put all of your eggs in one basket, but you also shouldn't invest in more companies just for the sake of diversifications. There are the same great companies out there in the market that have continuously been doing great, such as the Coca-Cola, Apple, Berkshire Hathaway. Because they are such the great companies, they will definitely survive any crisis and would continue to grow. Each of these companies has lost double its stock price since the last recessions. Number 6. Dividends matter. When it comes to the making profit out of the stocks market, what people mostly look at is the stock price. The strategy is simple: buy at low, sell at high. That's the good strategy, but stocks don't just go up and down. They provide the state of the company, which means every time the company makes the profit, it has to spend your share of the profits. That is known as dividend. Stocks by itself isn't really that helpful. Yes, of course, if the stock price keeps rising, you will be wealthier. But you're the only getting wealthy on the paper. You can't materialize that wealth unless you sell that particular stocks at the higher price. It's like buying the piece of the real estate and then waiting for its market value to increase instead of the rented it to profit from it every month. And then you use the profits to buy more real estate or these dividends to buy even more stocks and grow wealthier. Passive income is always great. Of course, sometimes it's better if the company does not pay dividends, especially if it is then early stages or if the company has the potential to reinvest that profits to grow much faster. Next, the stock market isn't your only options. When you hear the word investors, the first things that come up to mind is the stock market or the real estates or government bonds. They are all great investment tools, but they might not always be the perfect choice. Remember, investments comes into different shapes and size. Sometimes the best investment specifically for you might be that business you have been thinking about for some time. Or maybe if you have the plenty of the extra time after your job and you have the passion for the graphic design, investing in the Photoshop course might earn you much more than if you would have invested that cash into the stock market. Investing doesn't always have to result in immediate materialistic gains. Maybe investing in the self-help books or the finance books will have much bigger impact on your life in the long run. That's any other kind of investments. The point is, think outside of the box. The opportunity might right under your nose. And lastly, patience is everything. Finally, after the few months of the savings, you have earned enough to invest, but you can't find the good deals to the market. What do you do? Wait, of course, sometimes the opportunity strikes and you have been quick enough to take the advantage out of it. But quite often they are the traps that will simply drain your money. Don't rush, carefully analyze the market, read more articles, and invest when you are confident enough. That also applies to the selling. If the market is down, don't be the fool to rush to sell all of your stocks. Maybe that's temporary and the stock price will rise back. Don't be driven by your emotions. Learn to be patient. I hope you guys have enjoyed this video. Make sure you give this video the thumbs up and leave the comment because that will really help the channel. And of course, hit the subscribe button if you are new around here. Thanks for watching and until next time.